Good morning, everyone. Welcome to Coffee with Carlson. Today is Monday, October 26th. Sorry for me looking down. I feel kind of like George Bush from the 1992 debates. He's getting a lot of flack for that recently for some reason, but I looked at my watch real quick, and I apologize. How are you this morning? Today is a fine day. It was a beautiful weekend. Temperatures are great. I don't know about you, but my wife got me out of bed at 5:30 this morning to do a half-hour workout and a half-hour run. So I got to top it off with breakfast at Dee's with my buddy Dan. We had a wonderful time. Now we're chilling in Studio 129 with some strangely warm coffee. Dan, how are you this morning?
Sorry, I didn't have my microphone on. I'm fabulous. What a great weekend we had.
Got to throw him under the bus there. So guys, we've been talking about some business tax issues, covering different topics. I'm going to try now. We're at the end of October, beginning of November next week. It's time to start thinking about some year-end planning. This week, I'm going to talk a little bit to you. You can't really do anything to change this moving into the end of the year, but at least it's something for you to start thinking about, putting some numbers together and collecting some documentation and maybe something relevant that'll help you moving forward to make some decisions. So the next few weeks, we're going to be talking about year-end planning and things you can do to get ready for that. Today, I'm going to focus on itemized deductions. This really hits on the individual side of year-end planning or planning in general and how they work, some of the changes that have occurred. So let's dig right in and get this show started. Sorry, I like doing that. Anthony Brian Logan, shout out. I love his videos. It's one of those cool things that I like. All right. So a big one that people ask a lot about are medical or dental expenses. This includes things like doctor visits, insurance. They all have some individual, that's why they have that shock mount thing on these things sometimes, have individual limitations, but overall, it's those sorts of things. Durable medical equipment, improvements to your home, prescription medication, and how are those deducted on your tax return? So first, the overall limit on itemized deductions is you have to meet your standard deduction. Standard deduction is what you get if you don't have any of these expenses and you just file a standard form. That changed a couple of years and just about doubled. So most people, I don't want to say most, but a lot of my clients no longer were able to itemize. That's not a bad thing, but it does kind of penalize those people that own a home, have medical expenses, have things they have to do, money they have to expend. So from that regard, it does have an impact. Now, the Affordable Care Act a while back, about 10 years ago, the Affordable Care Act changed the itemized deductions limit for medical and dental expenses to 10%. And that's going to be that from now on. That means that you can only deduct medical expenses that exceed 10% of your adjusted gross income. So I do those quick calculations with my clients. Sometimes we have a lot of retirees just so they can get in their head. You pretty much know the total amount that you spent on medical expenses last year. So if you made $100,000 last year and that means your medical expenses have to be over $10,000 before you can deduct $1 of medical expenses. So it's a pretty big limitation for people. Most people aren't getting that, don't get that in general, but now with the higher itemized deduction limit or standard deduction, you're not going to get there at all. So if I had $20,000 of the medical expenses last year and my income was $100,000, that means that theoretically I'm going to lose the first $10,000 of my medical expenses, so it only leaves $10 available. If I'm a single person, my standard deduction is $12,700, then I'm not going to get to itemize at all. So it's not going to make sense for me to do that. So really think about that. Look up your category, your tax bracket to see where your filing is. You could do a quick look at last year's tax return to see what your standard deduction is if you got sick and had some out-of-pocket medical last year, so that you know whether or not you need to keep track of it. Now, a lot of people miss certain deductions related to medical expenses like mileage. So for instance, if you were unfortunately diagnosed with cancer last year, we keep you in our prayers. Always pray for everyone that's suffering from cancer. And you had to go to Moffitt. That's a pretty good drive, about 85, 90 miles from Sebring to Moffitt Cancer Center. If you had to go there once a week or multiple times a week, those miles could add up relatively quickly. So make sure you keep a log of your doctor's appointments, even locally. If you go to the doctor every week, that could be, depending on where you live in Highlands County, that could be a 10 or 15 mile drive. It might be a 1 mile drive. You never know, but keep track of those miles. Even if you have a little planner book or calendar that you can write them in, it's one more thing that you can get a deduction for. So you want to keep track of that as well. But especially if you're traveling outside of the area, if you're a veteran and you're going to one of the veterans facilities in St. Pete or South Florida, you can keep track of that too. Although you're not going to have a whole lot of out-of-pocket medical, we hope. But if you do, keep track of your miles as well. The next thing that changed a few years back is an overall cap on state and local taxes. So in Florida, we don't have state income tax, but we do have state sales tax. So the IRS gives you the ability, and property taxes. Those are the three main types that you're going to deduct. So property taxes on your home, you can add these into that figure for itemized deductions. The sales taxes that you paid for last year on the items that you purchased, there's two ways to deduct that. The first one is a standard formula, which 99.9% of my customers use, but occasionally the standard formula, but you can add actual expenses to the standard if you bought something large like a car, boat, or RV. So you can add that actual single expense to it to get the number up just a little bit. But I do have some clients, believe it or not, they total up their sales tax for the entire year and give me that number. And if you do that, this particular client, it definitely comes out greater than the standard formula based off of their income. So if that's something that you want to do, remember that with any deductions, you're going to have to verify it and produce evidence of it if the Internal Revenue Service ever asks. I'm not going to ask for it if you tell me what your sales tax is. I generally, if you're one of my clients, we have a trust relationship, so it's not something we have to worry about. But remember that you've got to have the backup for it. And the final one is state or local income tax. I have a lot of clients scattered around the country: Michigan, Ohio, Wisconsin, Indiana, Illinois, Rhode Island, Vermont. All of those places have, California, all of those places have a state income tax. We can add those in there as well. You can't, if you do live in a state with an income tax, you can't add income tax and sales tax, but you're able to take income, whichever one is greater, the income tax, your property taxes. The one thing about state and local income taxes I think a lot of people don't understand is that you pay your vehicle registration at the tax collector's office, but in Florida, those taxes are arbitrary, meaning that when you go to pay your tag renewal at the end of the year, say it's $53, it has nothing to do with the value of the car, which makes it not deductible. So if you pay your tags for $50 or $60 a year, you don't get to deduct that on your tax return. It's not eligible. But if you live in a state that bases your annual car registration off the value of your car, I believe South Carolina might be one where they actually use Blue Book value or some valuation of your car every year and send you a bill based on whatever that valuation is. Then you are allowed to deduct it. It works kind of the same way as ad valorem taxes and the value of your property. The next big one, and there is an overall limitation on that one as well, and that cap is $10,000. So unlike the medical and dental expenses, state and local income taxes, or state and local taxes, not just income taxes, but state and local taxes, that overall limitation is you cannot deduct any amounts greater than $10,000. So if the property taxes on your house are $12,000, you're only going to get to deduct 10, or only 10 is eligible to be totaled up for your total itemized deductions. Excuse me, my eyes do veer down. We set the computer up trying to get Joe Biden teleprompter set up, but we couldn't get it quite high enough for the camera. The next one is home mortgage interest. So my computer's right here, just so I can read my notes, which I've been working on diligently for weeks and weeks and weeks, as I always do. The next one is home mortgage interest. This one has changed a lot over the last few years. There used to be a cap on home mortgage interest for buying or improving your primary residence. You could only deduct mortgage interest on up to $1 million. I know most of my clients do not have homes that are worth $1 million or cost them $1 million to build, but those of you that do, now that limit is $750,000. So it's kind of a big number, because if you live in South Tampa, for instance, there aren't many houses less than $750,000 to buy. So in that scenario, you're only going to be able to deduct the mortgage interest on the amounts up to that 750. So what you'd have to do is create a quick spreadsheet with a ratio to come up with what the actual, or a new amortization schedule at that stated interest rate and term for just the $750,000. And believe it or not, in 25 years, we don't really have any of our clients that get audited by the Internal Revenue Service. Now maybe we will because of my show and they're keeping an eye on me. But the ones that have, one of the things they questioned was mortgage interest. And I had a client that had, I think it ended up being about 1.2 or 1.3 million at a very high interest rate. So that caught the eye of the Internal Revenue Service, and they asked about it, and we had to provide proof. After that date, we were then required to create the formula to track only the mortgage interest that was less than $1 million and now less than 750. So be very careful with that. The other thing that changed is home equity line mortgage interest. Used to in the past, people would go out and buy cars with the home equity line on their house. And the idea was that now I'm converting a loan that's maybe a higher interest rate to a lower interest rate, plus I get the ability to deduct the home equity line interest on my tax return. And that went away as well. So home equity line interest now is limited to only buying or improving that real property. So even if you use that money to buy a piece of investment property, say a rental property, some people do that. They leverage their current home in order to get a loan to buy a piece of rental property. Then you can utilize that interest there, but that's a different topic to discuss, and how you trace those rules and how you divide them out. And a question came up in one of my peer review forums just yesterday about what do I do if in that scenario where someone had a mortgage interest, primary mortgage loan on their home, they got an equity line to buy a piece of rental property, and then now that rates are so low, a lot of people are consolidating those two loans into one. And what do we do in that scenario? Well, you can trace that too and split out the two loans. Probably the easiest way to do it is to create two amortization schedules at time the loan is originated. That way you can track them separately for the different pieces of property. Now so that's home mortgage interest in a nutshell. Very quickly, I'm going to have a quick sip of my strangely warmed coffee, which you can pick up at Legacy Bicycles in downtown Sebring at the 204. Stop by anytime. Okay, the next one is charitable deductions. Now, this is one that I feel was targeted for quite a while. Targeted meaning that they were getting a little bit more restrictive, and it looked like they were going to make the rules more restrictive. But for the first time since I've been doing this, charitable deductions now are limited to 60% of adjusted gross income. It used to be 50% of adjusted gross income. Now, I know you're thinking right now, like, well, that's crazy. How would I ever get to 50% of adjusted gross income? I don't know. If you won the lottery, if you sold your home and you had a bunch of equity built up over years and years, and maybe you want to help out your church or another not-for-profit, that might be a way that you get there. But in general, that number is now higher. And that's a good thing, because the more incentive we give people to donate, unfortunately, some people don't donate at all. I think everyone should, but even if you can't deduct it, that shouldn't be a reason to. But if you can, and you can give a large amount, that number is now 60% of adjusted gross income. And I do have some clients that have pretty large incomes, and they donate quite a bit of money on a regular basis or at one time to set up a charitable foundation. That does come into play then, and it's something that you want to think about. Now, one thing that's been really hot, I know a lot of people hear about this on the radio all the time, I do, is Cars for Kids. That's KARKIDS, 1-800 Cars for Kids. I know you've heard the jingle. If you donate any, and I actually had a client that did this last year, donated a car to one of those organizations. I'm not sure if it was Cars for Kids or not, but if you do that, you need to get a written appraisal, whatever it is. If it's over $500 in value, you want some professional telling you what it's worth. So if you're going to donate a car, you can get the market values on those are pretty easy to find. You can get them at kellybluebook.com, so it's not that big of a deal. If it's a piece of real estate, if it's a low dollar value, you could probably get a market value assessment from a realtor on their letterhead, If it's a large value piece of real estate, you're going to need to get a written appraisal and pay to have that done in order to have, and you need to do it now so that you have the justification later if you're ever asked to provide it. You want to make sure that you get it. Charitable contributions. And the last two things I want to cover real quick, casualty and theft losses. So generally you think about, at least pre-Hurricane Charlie, right? We thought about casualty and theft losses as someone broke into my house and stole a bunch of things. Could I deduct those? There were some limitations on them, but you could. If your car got stolen, you could deduct those things. That's been taken away now. Casualty and theft losses are limited to federally declared disaster areas. So if a hurricane does come through and destroy your house, or a flood or a tornado, you can still get those deductions. There's lots of limitations and crazy things to work out there. So if you do have that issue and you think you need to deduct it on your tax return, please see a professional, give us a call, whoever you work with on a regular basis, and let them help you with those calculations, because it's something easy to mess up. And finally, I talked about this a few weeks ago, but unreimbursed job expenses for those of you that are employees of another company, larger company or someone else, if they're not reimbursing you for mileage, cell phone, things like that you use for work, you used to be eligible to deduct those as an itemized deduction, and that is now gone. You can no longer do that. And that's a big thing for traveling salespeople that didn't get reimbursed for mileage. I have one client in Texas, has 30,000 miles a year on his car driving around. So that was a pretty big deduction at $15,000 for that deduction. So that was pretty big. So overall itemized deductions, all those things I just talked about have to exceed your standard deduction. I know I covered a lot of stuff here. If you have any questions or have any follow-ups, drop a line below or visit my website, www.carlsonaccounting.com. You can go right on there, grab my email address, send me an email, ask me a question. You can also, right there on the calendar, hit the appointment at the top menu bar, and you can schedule a time for in-person meeting. We're still open and doing in-person meetings. That syncs with all my calendars. I can do video calls. I actually have 2 video meetings today, and I have 1 phone call meeting today. So however you want to meet with me, our office can make it work for you and have the technology available, even if I use Studio 129 to do it. Thank you very much for joining me this beautiful Monday morning. Enjoy a nice warm cup of strangely warm coffee, and God bless.